Joe, great to have you back on. We're continuing our conversation. If anyone hasn't seen part one, I'd strongly recommend they check it out. And today we're going to be diving into how you can protect yourself better as an execution trader or as a market participant. So thanks again today.
Great to be back. Thanks, Freddy.
You've been asked to appear in front of Congress. I actually read in your book that you were invited to a number of industry events to help make markets fairer. And it turns out you were probably the only guy they'd invited from the side of making markets fairer, because when you turned up, you were a little bit ambushed by some pretty well-heeled corporate lobbyists and HFT owners. So can you talk me through that?
Yeah, it's always fun when I do one of these conferences, and I'll be on a panel, and most of the other panelists have sponsored the event, and I'll be the only non-sponsor. It's just, I know exactly what they're going to say. I know the party line, but they're really good at what they do, and they're very well versed. When it comes to lobbying and how they spin things, they know how to go to the certain, Congress people with these perfectly produced white papers, with cherry-picked data, will convince that person to support their arguments. And I'm coming out there, I've got a small shop in Chatham, New Jersey, and we're here trading for institutional investors. I'm not a lobbyist, right? I don't do that. I don't have the infrastructure to fight them on the Hill. I don't have the infrastructure for all that they do. Now, we do have a good voice, and I will go on TV, and I will do on podcasts and so on, and talk about it. But it's pretty tough when you're fighting the corporate lobby. And just as an aside, over the weekend I read a 24-page report from Schwab on why payment for order flow is so great, and it was really well produced. And I looked at it, and it had all the different departments fed into it, and I read this and I said, if I was a regulator or policymaker, I'd say, damn, this is what I need to help support the case that payment for order flow is good, because they did they produced numbers, 3.2 billion, great for investors. But when I dig into it, and I will be doing this later in the week, writing a research note on it, I'll pick it apart and I'll say, what about this, what about this, what about this? You forgot this point, you forgot this. But that's not, unfortunately, how laws are made and how policy is made. There is a group, actually, in DC called Better Markets, which we've done a lot of work with, who are, I would call, the anti-lobbyist. But they speak the language of DC. And Dennis Kelleher is the guy who runs it. He's a great guy. He's appeared actually in a bunch of shows lately about the meme stock craze, and Dennis was explaining what the problems were. But he can go out there and tangle with them, and he can fight, toe to toe, and he knows all the players in Congress as well. So finally, there's one group. Thankfully, there's one group, and Dennis has been doing it great for years now, actually. He's been doing it. But it's difficult, to say the least.
Okay, so let's talk about some key battles you've been thrown into. What are the issues that the HFT and lobbying groups want to change or remain the same, and how can we push back against what seem to, from my seat, be like some pretty predatory order types, order flow, and other mechanisms that are making markets less fair for investors?
Absolutely. After the meme stock problem, Chairman Gensler of the SEC this year, actually in June, had a speech saying that he's going to have a market structure reform. And he had some ideas that he passed on to the staff of the SEC to come up with some recommendations. We're still waiting on the recommendations. They should be coming out shortly. But there were a number of hints in there, which the chairman basically said, this is what he wants looked at. One, of course, was payment for order flow. He wants to know, do we need it? Does it conflict? Does it hurt order routing? Is it hurting the retail investor? He had a lot of questions on it. The industry, like I said, is already getting in front of that. And they've been getting in front of it for years. And they will defend that to the death. Okay, so do I think payment for order flow is going away? Absolutely not. Would I like it to go away? Yes, tomorrow. Okay, I don't want rebates. I don't want payment for order flow. I think it distorts order routing. But it's not going away because of things like that paper I just mentioned. Will they try to reform certain things? Yeah, you're going to hear things like, we need more disclosure. That's the problem, Freddie. There's no disclosure. There's the 605 reports, and we should do more of that. That's BS, okay? That's just BS. The other thing that they might do to kind of address the issue is change what they call the tick size. And the tick size is just simply, when you're quoting a stock right now, it's a penny minimum. All stocks are the same. They tried a tick size pilot years ago where they tried to say, okay, what if it was a nickel or a dime? Would that create more liquidity? And it was actually pretty interesting, the report. Most status quo people on Wall Street hated it, naturally, of course, because they want more price points. The more price points, the more arbitrage, the better for them. So right now, the big argument going on is, what should the tick size be? Everybody's staking their position. The New York Stock Exchange came out with their paper, and they recommended a half a penny throughout. They just did a half a tick as well as, and then on trade size, they would do a quarter penny on trades, okay? Citadel came out with a paper recently, and they said half a penny for what they call tick constrained stocks, or the active ones, and then not a half a penny for the rest. An HFT lobbying group was out there recently, and I read a piece by them. They want a tenth of a penny. God help us if it goes to a tenth of a penny. That's all I got to say. Right now, at that I'm done. If it goes to a tenth of a penny, it's going to be a total. Think about it. All of those price points that could be arbitraged and picked ahead and sliced ahead and racing to that exchange center just to beat those price points, it would be a total disaster. I think the answer is somewhere in between. I'll give them a half a penny on the tick constrained stocks, but I actually think the tick should be wider in tougher names. And you're going to say, Joe, you're costing investors money. I didn't say the spread should be wider. I said tick should be wider. So what's to say if you could say, okay, a nickel, a dime. But what's going to happen is those HFTs who normally jump ahead of you for that penny, which is a low risk, it's going to cost them a nickel now. So will they jump ahead? Probably not. And now maybe, just maybe, folks like us will say, I can add more liquidity to the displayed quote and not feel that someone's going to jump ahead of me. And now I'm going to build a much deeper liquid infrastructure, okay? Almost back to like the days of the New York Stock Exchange where you had deep quotes and you had liquidity without the fear of somebody running ahead of me. That was tested, okay? The SEC tested this model. There is some data to back up that assumption. I wouldn't mind seeing that. I think that actually would be a good thing. And then you could put a trade increment in between, okay? But the quote itself could be interesting, but we'll see. So this debate, if you want to call it that, is deep-pocketed. They are fighting it to the death. There are some other things that the Chair Gamson recommended. He recommended the SEC come up with their own best execution rule. FINRA already has one. The problem with the FINRA best execution rule is it's never enforced. It's rarely enforced, I should say. So if they were actually to enforce the rule, they may actually do some damage here. So what's the SEC going to do? Create their own best execution rule? Is that going to be enforced? You know, that's the problem here.
Right. More disclosure. Around GameStop, one of the things that came out was, we need more disclosure of short selling. Now, ironically, the people to least benefit from GameStop and meme stocks were short sellers, the few of us that are left in this miserable business. Now, there are some tools that are available for institutional short sellers. You know, they cost tens of thousands of dollars. They're pretty widely used on the street. There's 2 or 3 platforms. As with everything, all these good ideas, they just get rolled up and eventually private equity or some large data provider owns all of them. I'm not sure of necessarily the complete accuracy, but they form an accurate enough picture for most institutional investors to get a pretty good understanding of the short interest in a stock. I understand from a paper that you guys wrote, there is more disclosure that might be available intraday on short selling, which I had previously not been aware of. So I'm very interested to hear about that.
Yeah, this is a really interesting story. And actually, it was identified initially by a friend of ours by the name of R.T. Luchthofer. Now, full disclosure, I've never met R.T. Luchthofer. We don't know who he is. He's an anonymous being out there somewhere. But he's
another anonymous short seller.
But he's a market structure guy who really knows the inside out. I don't know who he is, but either way, regardless, he identified there was a filing going back to these rule filings that the SEC that mandates the exchanges put out. One of the exchanges, the CBOE's BATS exchange, so they own 4 exchanges, right? One of them put out a rule filing and said, we would like to develop a report which would identify short selling throughout the day, basically sell this out there I don't know how much time they want, every 15 minutes or so, identify what's going on through our exchange from the shorts. It was like, wait a second, you want to do this intraday, tell them who's short, who's long, and who's buying and so on. Not who, but when a short sale happens. If I'm reading the tape, which I'm doing throughout the day, and I'm watching for buys, and I'm watching for trades, I don't know if I don't know if the trade was a long sale or short sale. Nobody knows. So why should an exchange sell or give, whatever, they didn't actually say what they were going to do, sell it or give it, information away on these short sales? Needless to say, thankfully, there was a bit of an outcry on this one. Letters were written. We wrote a letter. And the exchange backed away and said, oh, we're not going to do that. We're not going to do it. We'll do it end of day. We'll do it end of day on a trade-by-trade basis, okay? It turns out they already have it. So if you go to the CBOE's website at the end of every day, within an hour of the close, you click on today's date, you will see every short sale that happened on that exchange. You will know if it's short exempt, by the way. It'll even mark it as an exempt trade. So the market makers are exempt because they have a locate, the exemption and so on. At the end of the day, it's not just, okay, we had 2 million shares of short sales. No, at 7 o'clock, 100 shares went off short. At 7:01, 100 shares went short. So you can reasonably develop an algorithm yourself, I would imagine anybody can, because as we all know, trades don't happen just in one day. It takes time, especially if it's a tougher name. Now, if this is, Ford or GM or one of these super active names, it's probably not going to be that much of it. It won't matter that much. But if you spot this in a name, let's just say that doesn't trade that often, maybe 200,000 shares a day, and you spot a pattern day after day, you could probably develop a pretty good intuition that something is going on here. So that's out there. That's out there. The other exchanges provide this information as well at the end of the day on an aggregated basis. So not on that order by order level basis, which RT Lukhofer and ourselves finds a bit ridiculous.
Right.
Why should an exchange give out information? I'm a member of the exchange. I come there as an anonymous member. No one knows what I'm doing. Why should they know? And now they're giving out, not my name, of course, they're not giving out the name of the firm, but they're indicating when and what time that trade happened. So we think that's excessive information that shouldn't be out there. It's to be determined what the SEC does with that. We don't even know, actually, if it was even filed initially, that they put this out there in a filing. It's been there for years. Yeah, and it's on their website. It's free.
So should short sellers who value discretion, should they avoid that exchange entirely to preserve anonymity?
I won't say, and it's 4 of their exchanges that they supply. They're all 4 of them. So that's not up to me, but I think that it's, it is questionable why this exchange, or 4 exchanges rather, the CBOEs, decided to do that while the other ones don't. I would actually call up maybe New York Stock Exchange or NASDAQ and say, what's with these guys? Why are they giving out that information? Now, again, that they'll say, well, that's just part of the puzzle. You might be trading throughout the day you might be only doing 20% of your trades there. Maybe you're doing 20% on New York, 20% on NASDAQ, 40% on dark pools. You're all over the place. But still, it's information that has to be questioned. This is part of the leakage. That's just one example, right? Leakage is, years ago, we found something. We wrote a paper called Data Theft on Wall Street. They love us on Wall Street. Nice name, Joe. Where'd you come up with that? But basically, we identified a situation where in the data feeds, they were identifying, the exchanges were giving out information on hidden flow. When you go to an exchange, you light up your bids and offers and everybody can see, well, even if it's just a reserve book, which is 100 shares or and you have more behind. But you could also place hidden orders in between the spread on an exchange. You were able to determine based on the order IDs and the information that was being given in these proprietary data feeds that a hidden seller was out there, that information was giving out, and whether or not it was a buy or sell, too. We wrote this paper, actually, it was funny, it was that years ago, and nobody in the U.S. seemed to care. But somehow it made its way over the pond, and in the U.K., a couple of fund managers picked it up, and they said, what the hell is this? They started screaming, and next thing you know, a couple of things happened, and the exchange changed their way. So that was a win, one of our, wins that we found, which was nice. But again, we're a small firm. My job is to trade during the day. My hobby is market structure research. I think there should be others out there digging through all of this stuff, non-conflicted parties. Unfortunately, everybody's got an interest. Everybody's got an interest in keeping the model the exact same way.
So I want to get to a very controversial topic, the naked short sale. Most of the short sellers sit around somewhat bemused every time I'm in an Uber and guy asks, what do you do? And it depends on the kind of mood I'm in. Sometimes it's glamour photographer. But if I'm in a chatty mood, I might tell him I work in financial markets. And the response usually comes back in, my aunt, my son, my brother, myself. I own a ton of AMC and we're just waiting for the shorts to be squeezed out and the naked shorts and all that. And as an institutional investor, as far as I'm concerned, there is no naked short selling. There are failures to settle, and that accounts for some portion of this naked short sale thesis. But I have to go to a borrow desk. It's not super exciting. Do you have X shares available? Yes, we have this at this rate. And then I go to maybe another person execute, or those two parts of the firm, even within the same firm, are walled off. And I'll say I would like to short sell X amount of shares of whatever. And based on our earlier conversation, I might be giving out the wrong order types, it turns out. But I would like to short sell X amount of shares. And they'll ask me, where's the locate? And I will have to tell them, and often with a locate ID. But some work you've done recently suggests there might be a problem.
Yes. Well, the way to look at it, I mean, market makers don't have that. They have a short sale exemption. Their inventory management, this is part of the rules. It's the way it's written. And for the most part, that's fine, okay? There was a situation recently which the SEC fined a broker by the name of IMC. This is all public knowledge. $125,000, which, to some folks like us might sound like a lot of money. To them, it's okay. It's in the couch cushions. Yep. It's nothing. Okay. Why did they fine them $125,000? They run a system, like most market makers do, called an SDP, or a single dealer platform. So kind of like an ATS, but not quite like an alternative, kind of like a dark pool or an alternative trading system, but not quite. A single dealer platform is, they are basically, it's their own inventory. They're saying, I would buy or sell X amount of shares right here. Are you interested? And they send out indications of interest throughout the day to various brokers and whatnot. A response would come back, and somebody can come into them and say, yeah, I'd like to buy, 500 shares. What they send out, and this is part of the case that was interesting, is the side and the size. They don't send out a price. In order to be qualified as an order under the SEC's domain, you have to have a side, an order size, and a price. Since there was no price, what's in the SDP is not an order. And if it's not an order, it's not considered bona fide market making. So the market maker exemption didn't apply. They're not the only ones who run an SDP. All the major market makers run their own SDP. The SEC basically said, for 3 years, from 2017 to 2020, millions of trades were let off, were done this way, without a short sale borrow. And they needed to have a borrow because they technically were not market making. Now, the market makers and some folks will say this is just a technicality. I try to raise the issue. I talked to a couple of people in the media. I said, this is a big freaking deal, right? Don't you think so? No, I don't think so, Joe. It's like inside baseball. It doesn't really matter. You're telling me that millions of shares are traded for the last 3 years that didn't have a short sale locate on them, and that's okay. And the SEC said this is not allowed, and they fined this firm. Apparently, I guess nobody really cared. I think this is a situation where maybe we should take a closer look. Why do market makers get short sale exemptions? Well, it's always been that way. Well, at least on an SDP, they don't have an exemption. Therefore, if they're short selling through an SDP, that's illegal.
Going back to my earlier comment on maybe I've been routing orders the wrong way all these years. In your book, you talk about a situation where a client phones up with an order, basically kind of says, why is it every time I give you an order, the price jumps one way or the other? Like, I don't think the insinuation was you're doing something wrong. It might have just been that you're not very good at your job. And I've seen this myself, where I give out an order and it might be, buy this over the next 20 minutes. And lo and behold, I don't want to call the broker up and scream at them, but I do see the thing jump and I'm just like beside myself. What's going on there?
Yeah, that situation was probably back, I think it was like 2005. And that's when we kind of realized we better figure this out or we're going to be out of business really soon.
Okay.
Right? And
then, I promise you, you can trade badly and still stay in business. I'm testament to that.
Well, certain brokers are lucky because they can do that for whatever reason. I won't get into that. But basically, they're signaling, okay? And it's really, anybody listening, post a bid, right? The stock is 10 cents, 12 cents, or 10 cents, 15 cents, let's say. Post an 11-cent bid. Tell me what happens. I guarantee you some joker will go 12 cents, maybe the offering fades, and next thing you know it's going to be 13, 16, and nothing happened. As an institutional investor, and even a retail investor, when you place your bids and offers on lit exchanges, you're basically flashing a red light telling everybody you're not an HFT, because they're not going to do that. They're going to flicker all day long. It's a constant flicker. Well, you'll go in there and you'll sit there, and they'll basically say, here I am, I'm an institutional investor. I've got more to do, by the way, so go ahead and run ahead of me. That's what the assumption is at that point. So the trick is not to signal. And there's all different ways you can do that, as to try not to signal and randomize like we were talking about. But when we figured out that market structure matters, and that's how the game really happens. It's like if you were running an F1, race car. It's nice to drive it around the track, but guess what? You better know what's in the engine. You better know how that engine works, because it's really important to the speed, right? And we figured that if we don't figure out what's going on in the engine, we're not going to be in business long enough. And I still, listen, do I know everything? No, I just kind of hang around the edges and try to figure out as much as I can to keep my clients safe. That's what we do all day long. But the key of that situation is, if your broker's out there, and we'll call it in a sloppy algo, okay, there are good algorithms and there are sloppy algos.
Let's focus on the sloppy ones, okay? Because I don't want to get into your trade secrets on the good ones. What are the worst algorithms you can be in?
Right, I won't name them, okay, and by the way, here's a weird thing, people will say you're lying, but no, we don't trade I don't use algorithms.
Okay.
I trade manually, okay? As sick as that sounds, it requires a lot of work and an intense level. Now, it's all electronic, of course, but I'm not using a scheduled algorithm to do that work. A sloppy algorithm is probably being incented through economics. In other words, hey, Mr. Institution, guess what? Joe here. I'm working at Joe Schmo Brokerage, and I came up with this new algorithm. How would you like to try it for free? 5 mils a share, maybe, even something real, and I'll give it to you. Well, you're going to be like, wow, this is wonderful. This is a cheap algorithm. Now, what's that algorithm going to do? They're going to go to the lowest cost venues, or to the venues where they can maximize their rebates. So in other words, they need to make money. Right. They're not doing it for free. So maybe instead of just crossing the spread and buying 1,000 shares and getting it done with, because it would cost him 30 mils to do that, he posts that bid out loud, trying to gain the liquidity rebate. Well, by that time, the jokers, the HFT guys, have seen it. They've bid it up. Next thing you know, it's up, and up. Eventually, your guy gets hit. But he's paid 13 mils instead of crossing the spread initially at 11 mils. Right. Or 11 cents. He's paid 13 cents instead of... So, yeah, he got paid. Even though he gave you, just like payment for order flow we're talking about, it's basically the same thing. He gave you a free, he gave out to the street a 10 mil algo or whatnot, and made 30 mils on the back end, so it's still advantageous to them, but how is it for you? And that's where your TCA or transaction cost analysis, people do a lot of that to see if this is happening, and they will kick those guys out. And the sophisticated institutions out there will boot them in a heartbeat. They're not going to be using something like that. But there are always these games that are being inherent in the engine, right? They're still being built. I always say, if something's for free, right, you're the product. People always say that. If you're getting something too good, there's usually a reason why. They're not going to the right venues. They're signaling. They're coming through in a repeated fashion, in a non-randomized way. That type of stuff happens.
Do we just have to basically accept now that as kind of regular equity folk, like some amount of this is just inherent in markets? And are there ways that you can see over the next 5 or 10 years that we can actually push back and have markets back to being a structure that is buyers and sellers, as opposed to buyers, middlemen, middlemen's middlemen, and middlemen's middlemen, and sellers?
I don't see it going back. Unfortunately, as much as that pains me to say, I don't see it going, not back to the pre-Reg NMS when they were arresting the specialists and, you're yearning for the old days. No. I'm not saying that. I'm saying for a normal market where we can have less intermediation. It's just the powers that be are there, and the system is set up, right? It's hard, just like I talked about that 24-page white paper. There's plenty of them out there, and they're going to run around Capitol Hill. And then take a look at some of these Congress folks and who their donors are. And why, I always laugh when I hear one of the Congress people sound very sophisticated on market structure. I'm like, who taught him that? And how did he know what to say exactly over there? But, it's built that way. We can try to minimize some of the damage and tweak it around the edges. But then what happens is they'll put through a rule proposal. Let's just say the SEC says we're going to ban payment for order flow. Not going to happen, because there'll be a rule proposal out there. There will be comment letters written. There will be lawsuits filed. Major lawsuits. And this is, by the way, the new thing over the last 5 to 10 years. The market makers and the stock exchanges sue. They love to sue. The lawyers get rich, okay? And if they don't like a rule that the SEC put through, they will sue them and try to get it overturned. And it works sometimes. Or if at minimum, it'll drag it out for years, so they don't have to worry about it for a few years. So that's why I don't have much hope in this type of overly complex system going back to really a more simple system. And again, people will say to me, well, Joe, you don't know what you're talking about. We have the most liquid, deepest, most efficient markets in the world. And I will just say, well, why is everybody complaining? If they're that great, why is everybody complaining? So somewhere along the line, there's some issues that need to be addressed. Chairman Gensler of the SEC, I think, is going to try. And he really understands, I think. He doesn't have many fans on Wall Street, by the way. A lot of the big firms, they will snip at him all the time and say, no, you don't know what you're talking about. You're going to go overboard. You're going to do too much. You're going to have unintended consequences. Big term they love to use. But he was the chairman of the CFTC. Mm-hmm. He was an MIT professor who knew about all sorts. He taught blockchain and Bitcoin. He knows all about crypto. He knows all about commodities. And now he's in the securities world. I think he knows what he's doing.
Right.
Okay. I think he knows what he's doing, and I think he's going to try. Unfortunately, he's going to run into that brick wall of lobbyists and everybody else, and his term will run out in a few years, and then we'll start all over again.
Lobbyists and HFTs. I am blown away. I think I read Virtu's prospectus, and they lost money like 1 out of 700 days. Most lay equity traders are not losing money 1 out of 700 days. These have to be some of the greatest money creation machines ever invented. And it seems to be that there's an arms race element to it, and the big get bigger, and they can buy more infrastructure and hire more brains, and it feeds off itself. Do you have an estimate as to how much trading P&L HFTs are making a year?
When it first started, it was a machine. I mean, they were picking it off left and right. Mm-hmm. This is, circa 2007, 2008, 2009, super volatile years, of course, right? They were crushing it. And no one really came up with estimates, 3, 5, 10 billion, who knows? There's no way, because they were all private firms, right. Most of them you could never tell. They made their most money when the markets were just changing, when they were in their newer stage. And that's what happened in 2007 when Reg NMS came through. Everything changed. And the people who were smarter, who developed the systems first, they made a ton of money. But have written numerous notes over the years, and I've referred to the HFTs as locust. And they love me for that. But the reason why I say they're locusts
I'm not going to surprise you and bring like Doug's seafood. Don't worry, okay?
I know Doug, I like Doug. But the HFTs, and they're these independent firms that have one-page websites, okay? Right. Different from a market maker necessarily. I mean, market makers do have a bunch of things going on, right? They have different inventories and so on. HFTs, or takers, if we want to call them, go to the websites that used to be one page, you wouldn't see anything until you saw the SEC hit them with a fine for something, and then you'd read about them about that. But they crushed it at the beginning, and I called them locusts because I said they're like locusts going to a farm, and they're going to strip this farm and rip it apart as much as they can, and when they're done, they're going to go to another farm. Mm-hmm. The new farm is crypto. They've crushed it again. Who made all the money in crypto 2017 through 2020?
Ops.
They killed it because you're looking at an infantile market with no regulation.
With spreads as wide as you could drive a truck through, as long as the exchange didn't actually go out of business, which happened.
Which happens, but that's a perfect recipe for an HFT. Good God, it was like printing money. You talk about a cash machine. Mm-hmm. They didn't stop. Okay, and of course, crypto is a very sensitive subject, and God forbid I said something against crypto, I'd get killed right now, right? Listen, I think it's interesting. I really do think it's a fascinating topic. It's kind of a lot going on still, but these guys don't care what asset class it is. They're just going to move on to the next one, and eventually, crypto will get regulated. It will tighten up a little, and they're not going to make their money. And now there's a lot more people doing that. But the first HFTs that came into crypto must have just made God knows how much, right? So that's why they're locust. That's why they're going to move on to the next one.
Interesting. So do you think they've moved beyond equity markets, or are equity markets just not as fertile a farm anymore?
I don't think it's as fertile. I think they still are there. Derivatives are fantastic for them. They can play in the options. I think the good HFTs are multi-asset, and they're going to trade all different types of, different asset classes and look at it as a book and see it as one big piece. But I think the equity market has certainly matured a lot. Secretly, maybe some of them are hoping for rule changes.
Right.
Because when rule changes come about, it creates opportunity for folks who know the rules, first of all, who know how to take advantage of those new rules until they get arbed out and then move on to. So be careful, I guess. I guess I have to watch them too. Because if they're lobbying for a rule change that I might want, I might think again.
HFTs are multi-manager platforms. Both have been phenomenal money creation businesses, and the infrastructure and the brains of the people that run and built these businesses, it's truly breathtaking. Do you think, both in terms of market structure or models that overlap and the ways they think about risk, either of them present potential kind of black swan type risk? And that, for me, was one of the interesting things about the Melvin bailout, which I know as much as anyone else from what I've read, but it was one area where you sit there and you think, not that there's some vast conspiracy theories, but hey, I'd imagine Steve Cohen and Ken Griffin don't just out of the goodness of their heart bail people out, and perhaps there was something bigger going on in the background, not conspiratorial, just this might have been the lesser check to cut than something bigger. Is that something you've looked at or have any thoughts on?
I think when there were big players who command a huge chunk of market share, you need to be careful, because if that player were to disappear, you're going to have a gap in the market. And let's go back to the flash crash in 2010, and I think it's a perfect example of a liquidity vacuum.
Which they blamed on a guy in Hounslow in his bedroom who carried around everything in the Tesco's carrier bag.
Because he was trading futures in his mom's basement, I think it was, right? Now he wasn't the cause of the flash crash.
Right.
And it wasn't a mutual fund in Kansas City. Right? So they need to have, the problem was liquidity. There was a vacuum in liquidity. Why was there a vacuum in liquidity? We are assuming that they're going to be there, right? There was one HFT, famously afterwards, who was quoted, and he said, "When I saw the volatility in the market, I went to my computer and I typed in HF stop, which basically means get me out." Okay, now this guy, he wanted out. He wanted no part of it. Others turned around and said, "No, I'm going to press this thing," and they from what I understand, made a fortune. So they leaned on it on the way down, and they ripped it on the way back up, right? It all happened in 45 minutes, and it was over. This one guy decided to walk away. So if he walked away, and everybody else walked away, you're going to get, and we rely on that liquidity because you don't have liquidity providers who are mandated anymore. You're relying on basically proprietary traders who operate on rules that are not like everybody else. And one rule, by the way, which I think should apply to the bigger players, and it doesn't. The SEC has a rule called Reg SCI. I forget what it stands for, but it's basically the exchanges have to adhere to SCI, and it means that the SEC can get a closer look if there's a problem, if something happens. It's eyes and ears for the regulator to keep an eye on the bigger players. Brokers and market makers don't have to adhere to SCI. And I would argue that if you're commanding a significant chunk of market share, where the market is now relying on you, whether we like it or not, you probably should have more onerous regulations than you currently do, pretty much as a broker. I mean, they're regulated like I am. I'm a broker that's regulated by FINRA and the SEC. They are too. It's pretty much the same.
So feasibly, one of these very large players who are either responsible for liquidity or at least posting liquidity in thousands of markets, I mean, you can pull the plug, they can go dark, and we're going to know when we all hear it on the news, and that's it.
I mean, they could. I mean, I don't know. A market maker, if was sitting in this chair, they would say that would never happen, right? They would say, no, we would never do that.
Wall Street has a not particularly wonderful track record with the word never and risk.
Yeah, absolutely. And what's funny is, to be considered a bona fide market maker, you have to be quoting on both sides of the market, which is wonderful. And this happened, but only within a certain percentage of the MBBO, and I think it's like 8% of the within the. So if the stock is $100, you could be bidding 92, offered at 108, and you're considered a bona fide market maker, which then gets the advantage of a short sale, located exemption, and so on. Kind of a little loose there, right? Yeah. Now most of them don't quote that wide, but they could, and maybe if we did have a volatile event, rather than just pull out of the market, they would just spread them wide.
Right.
And maybe that's what we see when we see these gaps down for no apparent reason, or to upside. I mean, everybody talks about the downside. Happens on the way up, too. Mm-hmm. Same thing happens on the way up as it does down. What happens to the liquidity? Where did it go? Where was it in the first place? Market makers, HFT, supply liquidity when they want to. They're not mandated to. They don't have to. No one's mandated to supply liquidity in the market. when we rely on it, and I'm not saying they should, they're trading their own book, they're risking capital. I'm not risking capital, they're risking capital.
Sure.
But it's an issue, and it's certainly something that people should be aware of.
Where can investors go to start the process of learning about market structure, about order types, about order execution, and really keep that learning process going? Because to your point, things are ever changing, and it's somewhat akin to the drug testers and the guys at the Olympics running sub 10 seconds. There always seems to be a little latency between what's going on in both of those teams. Where can investors really get a handle on this?
There's no one central depository.
Right.
I mean, it's everywhere. I mean, market structure, years ago, we were like one of the few market structure folks on the street. Now every major brokerage firm has a market structure department with multiple people in them. Now, of course, they're biased to their own models, but there are people out there analyzing all this stuff. Rule filings are posted on the SEC's website, which I would recommend. I mean, it's really tough reading. It's not, it's not fun. Guys like me read this stuff, but it's not fun. But you can find some stuff there. I think Michael's book was great. People will say you're nuts, Joe, but I think Flash Boys was a real core. You can understand what the issues are if you read Flash Boys. But when you're talking about this day-to-day grind, we used to have a blog. I'd put some stuff on it. Once in a while, I'll still do. I read a note once or twice a week to our clients that will identify these type of things. Twitter, actually, there's a little market structure community on Twitter which talks, to each other and pretty much just yells at each other like everybody else does on Twitter. You're wrong. No, you're wrong. I don't like to mix it up on Twitter. I think it's a waste of time, to be honest with you. I like to talk and spread some knowledge if I can help, but to yell at people, what are we doing here, right?
There's plenty of that outside as well.
Right. What's the point? What is the point? So to answer your question, there is no one spot. The SEC is trying to put out some more educational stuff lately, and I think Chair Gensler is doing a good job, and I think he's trying to do it. Some of these congressional hearings, believe it or not, have been pretty good. The ones that they ran after the meme stock stuff were pretty good, but there's no one spot.
Yeah, I was mostly amazed at the congressional stuff with how little the Robinhood guy actually understood about his underlying business. And then only weeks later, they had Jack Dorsey on for something unrelated, and I was just amazed at how ill that guy looks for a billionaire. I was like, whatever that diet is, I want no part of that. I want to rather look like Elon Musk. But it did frighten me, actually. How little some of those guys really knew about market plumbing and capital requirements and how volatility increased their capital requirements. I mean, gamification of markets for me is totally irresponsible. I think it's become some sort of nihilistic Reddit porn thing, and this is actually a really important function in society. And while I don't sit here and think that market participants are necessarily doing it for anything than their own selfish interests, but it does really concern me that the gamification of markets has removed efficient allocation of capital as something that people seem as important, because it is. And while people often look at what we do and focus on, if these companies go to zero because they're frauds, which is not the bit they talk about, but if they go to zero, all the jobs are lost. We're like, well, what about the 15 guys who don't get the capital because the fraudster gets it, who could create real businesses? And much to your point on the data that is largely distorted by HFTs and people with vested interests, they're very focused on the liquidity that is created, or the spreads are reduced, and they're not looking at the data all over where there are places that actually money's going into their pockets. So I find that interesting.
What's interesting about the Robinhood guys is that they were on our radar as early as 2014, even before they did their first trade. When we saw that filing, and I saw the free commission model, and we immediately knew it would be payment for order flow. Those guys worked at HFT firms, the founders, so they knew market structure plumbing. So it was no surprise to me that they were going to build a model based on taking advantage of the market structure plumbing, which is exactly what they did. And for years, it went and did its thing. I think what also is interesting is not only in stocks, but the derivatives are the real problem. And if you look at payment for order flow, 2/3 of it is from the options market. That's where the money is. The money from the options. So who's trading all of these options. Well, maybe part of that is, like you said, the gamification model where, you get a little blinky, and the next thing you know, hey, you can put your leverage up 10 times if you trade it through an option.
Right.
And the thing is, 10 cents, maybe the option strike is, it's 10 cents off bid, 30 cents offered, and they give you 28 cents and they say you received price improvement. Good God. I mean, and you're buying some, crappy option that's going to expire worthless most of the time, right? You're playing in the wrong game. You're going to get killed. And who's encouraging that game? And absolutely. And I think Congress was aware of that. The SEC is certainly aware of that. I mean, how do you stop that? I don't know, but that's not investing.
So it's great you mentioned Robinhood. We actually became aware of Robinhood, not so much for the app itself, but there was someone who'd started scraping the data in terms of what was popularly held by retail investors, and we were using that as a way to find shorts before before people really picked up, with the idea that probably Citadel had that retail flow might not have been that smart. And it was a really interesting way for us because it was identifying by purely popularity. I don't even think it was dollars traded. It was just number of accounts that held that particular security. So we would find some random obscure OTC ticker that all of a sudden was held by like 6,000 people on Robinhood, which probably meant there was a newsletter out there promoting it to people, and that was actually causing the stock to spike. And when it became uplisted, there was usually bar available, and that was something that was interesting for us. The gamification, which you've touched on, do you think that's going away, or do you see it as here to stay?
I think it's interesting. I think it's kind of morphed into the crypto world now, right? Mm-hmm. People were loving the equities when markets are up, right? Everyone's having fun, and the FOMO and the TINA acronyms and all these other crazinesses out there, and they're all just clicking the buttons and making money. And as professionals, we know when it's gone too far when you're walking into your barbershop. So you're going, and it's gone too far. You just don't know how far it'll go after that. People want to trade that way. I'm not going to tell them how to trade. If you want to use a machine or an app, so be it. But I would say do your homework. I don't care how you do it. I don't care how you execute if you're, a retail trader, but do your homework. I always tell my kids, if they ask me they want to buy a stock, give me 3 good reasons before you want to buy that stock. I want 3 solid reasons. I don't want to just hear, somebody told me something. You should have at least that. So I think, gamification, it encourages speculation. Mm-hmm. It encourages, excessive margin, right? And that's where people get in trouble too. And now that, by the way, single stock ETFs, really?
Right.
I mean, is that what we're doing now?
Yeah.
We're leveraging up single stocks?
An interesting issue, I think, for firms and compliance, because most firms don't allow employees to trade PA, and I think there's a number of good reasons for that. But they have a carve-out for ETFs. So the question I pose is, are you now allowed to trade a single stock ETF that owns Tesla?
It's a great question, and I'm sure they haven't thought of that yet.
Yeah, I'm not pushing that, by the way. Yeah, my compliance officer is listening.
But you know what? This is a movement. There's hundreds of them apparently on file.
Yep.
And they're just going to, it's the dumbest thing in the world if you ask me. Buy the stock, but now of course they're leveraging them up. And
right.
So now if you buy a single stock, a 1.5 times single stock, and then you margin that, go to DraftKings, right? Okay, what are we talking about here? We're investing, but Joe, you're an idiot. No, I'm making money. You don't know what you're talking about. All right, fine. Go ahead, enjoy yourself. But I think it's a problem. I differentiate between trading and investing. Mm-hmm. Okay, I think investing helps support what we do, right? As Americans, capital formation, liquidity, right? That's what we do. Excessive trading and gambling, that's not what we do.
Well, Joe, thank you very much. It's been great having you on, and really appreciate your time. I'd strongly recommend people reach out to Joe and his firm, Themis. They really have some excellent papers on a bunch of these different topics. There's very few people that have an unbiased market structure view that Joe does, and if anyone hasn't seen part 1, I'd strongly recommend they check it out. It's been really great having you on, so thank you very much.
Freddy, my pleasure. Thank you.